My name is Morten Skipper. 4 years ago, my family and I took the decision to move from Denmark to Luxembourg.
My name is Vittoria. I lived in Italy before moving to Luxembourg 6 years ago.
I'm Cara Brown. I moved from New York to Luxembourg 2 years ago.
The thing that stands out to me in Luxembourg compared to other places is the ability for me to combine my career with a really good family life. So for us, it was very important that the kids would be exposed to other cultures and also have the English language as a first language. That is why we chose the international school system. But there is of course also the European school and the public Luxembourgish school system that offers a curriculum in English too.
After checking my emails in the morning, I take public transport to go to the office, which is very convenient and it's for free. I think that Luxembourg offers a high degree of diverse opportunities, particularly in the financial sector, because it's one of the main centers worldwide.
I love that it's so unbelievably international. You always meet people from other cultures, other nationalities. It's of benefit also in the work environment to have people from different nationalities.
I am the head of investor services and I manage teams in Mumbai and New York. Here in Luxembourg, people seem to make time to talk to each other. It's not the uptight, all business all the time type of attitude. There's a lot of knowledge sharing here that goes on, so that's been a huge help for my career.
The last 2 years, I've been working in private equity. I think that the environment for private equity is really exceptional. It is growing into a major PE hub, and it is growing in an incredible pace.
I have a dog and a horse, so I love to spend time with both of them. Mostly in my free time, I try to go for walks in the woods. It's my personal peace palace, I call it.
If I'm not working, whenever possible, Declan will ask to go over to the pirate ship park where he can run around. They've got the sand, the water play in the summer usually, so you'll see all the kids splashing around playing with all the various water, and the parents can chit chat and keep an eye on all the kids running around, so it's a really good spot. You kind of learn to just chill a bit, and you just take it in and enjoy your family life, your new friends, colleagues. It's been a really great experience so far.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Good morning and a happy new year to all of you who have joined us today for this very first episode of 2021 in our series Focus On. Today obviously dedicated to private equity. Private equity as an asset class has over the last couple of years really risen very importantly in terms of assets under management. This obviously is due in large part also to the investment environment characterized by ultra-low interest rates. In Luxembourg, obviously, private equity has also seen a very important increase. This, in part, is also due to Brexit, the decision of our British friends to leave the European Union, and the relocation of a number of asset managers in this sphere of their funds and their activities to the Grand Duchy. We will hear about all these different angles on private equity from our experts. And the first one, Ed Truell, has unfortunately not yet connected to this conference. We hope that he will, and we hope that nothing has happened to him that prevents him from joining us this morning. That is why I would like to introduce to you now already the speaker who was meant to follow him, and that is David Dana. David is the head of venture capital investments at the European Investment Fund. He is heading the tech venture capital team of the fund and has been working at the EIF for 10 years almost. Prior to joining the EIF, David has spent 2 years at PwC Corporate Finance, where he was in charge also of fundraising activities for startups and business valuations. David had started his career in private equity at Société Générale Asset Management in Paris, where he spent 5 years. And you see, he is certainly the right person to tell us more about Europe's venture capital investments. David, the floor is yours.
Thanks, Nicolas, and hi, everyone. Happy New Year. Healthy New Year to everyone as a starting point. I think that would be the most important element for 2021. Thanks for the invitation, and thanks to allow me to give you some insight on what are the current plans of the European Union in terms of venture capital investments. For those who don't know us in detail, very briefly, the European Investment Fund is an entity which has been set up more than 25 years ago in order to support innovation and job generation across the EU. Very early on, it was decided to do it in an intermediated mode, meaning that we never intervene into companies or projects directly, but through financial intermediaries. And the ones I am on a daily basis working with are VC GPs. And by VC, we mean everything which allows startups to raise money from very early stages, starting with technology transfer or even with business angel investments, up to later stage and growth investments, as long as the tech component is systematic. Over the years, we have seen that the market has evolved and developed in a kind of exponential way. As Nicolas mentioned, I joined the IF some 10 years ago. At that time, we were quite a small team of 8 to 9 people, investing on average 400 million a year, which was already quite significant and representing at that time between 40 to 45% of the overall European market. For sure, we were the largest player in Europe and largest LP in Europe investing into VC funds. This is still the case now, even though the figures have just nothing to do with that. The team has grown from 8, 9 people to currently more than 35 investment professionals. And in terms of volume of investments, we have grown from 400 million in 2010 to, and we closed the year 2020 on a new record year, more than 1.5 billion euros of new commitments into VC fund. And this is only talking about the regular mandates that we are managing, advising, and investing, putting aside what we have and what we will get from the European Union, European Commission, and European Investment Bank, which is our mother company, in order to support the GPs and the companies in this particular context of the COVID pandemic. So the market has indeed grown a lot. And what we've seen is that this evolution is also coming with an evolution of the sources of financing that we have and that we are managing and investing. The largest one have always been, and this is still the case, are coming from the European Investment Bank, the European Commission. The third largest one is coming from the German Ministry of Economy. And then we now have more than 35 other type of mandates, which are, depending on the sources, either focusing on a specific country or specific regions, group of regions. So this is a mix of mandates that we are managing and allocating depending on the specificities of every and each single VC opportunities that we are seeing. As I said, we are the largest LP. We have been over time investing in more than 600 VC funds. So we have quite an extensive view of what is happening in Europe and what are the trends. We have been also investing in almost every single EU country. We have invested in the UK for sure, in France, Germany, but also countries like Estonia, Portugal, Greece, a bit everywhere in EU where we see something happening. And part of our role is not only to invest in those VCs which have been already managing several generations of funds, but also the ones in kind of underdeveloped, in a way, VC markets. And for that, we have a developmental role, which is also kind of, I would say, super important for those markets, because usually especially when it comes to first-time teams, when the EIF is committing to a VC fund, it's providing a kind of quality stamp that best market practice have been implemented. The LPEA, and we know that this is something really highly important, is in line with what can be done and what can be accepted especially by European LPs, which are a bit, I would say, protective compared to what is happening in other continents. But at least we can be sure that it has been curated and looked at cautiously. So what is really important to understand is that this evolution of the market is really important, because this 1.5 billion euros I was mentioning, which is what we have been investing over the last 4 or 5 years on a yearly basis. It is now representing between 10 and 50% of the overall European VC market. So the market has grown from 1.5 billion 10 years ago to more than 12 billion a year of funds raised by European GPs. And this is what is really important to understand, is that 10 years ago, the VC market was looked as something not attractive, because the returns were not necessarily here. And additionally, we know that private equity is already a risky asset class. So if you look at one of these risky asset class, and if you look at the riskier component within this asset class, then you come to VC. And over time, we have seen a sufficiently large number of companies with European origins becoming successful to make it attractive for non-European investors, but also for European private investors, which has allowed us to decrease our relative market share while increasing our ticket size. So companies like Spotify, iZettle, Iden, all those companies are originally European companies, VC-backed companies, which have now become successful, generating liquidity back for their investors. So when we are investing in a fund, what are we looking for? This is something people always ask. Your EIF is a public entity, you are investing EU public funds. What are you looking for? Is that only policy objective or only financial objectives? At the end, this is a combination. We are looking indeed for financial objectives, because we are not here just to subsidize any kind of sector or market, but we are here to generate returns, while also ensuring the highest possible policy returns, which comes with a combination of elements depending again on the mandates, specific mandate requirements we are managing. But nowadays we are focusing on what would make sense and what could help Europe remaining at the forefront of innovation, and also continuing leading the technological transition and revolution. Because an element which is really important is that to consider and to keep in mind that if you just look at the number of engineers, Europe is far beyond any other countries. We have at least almost a double the number of engineers compared to the US. We are really advanced when it comes to fundamental research, to really specific techniques. But then the transition to market is sometimes missing. And that's when the non-European players come into the game. But this is also one of our objectives, is to support this market to make sure that we continue leading this. As an example, we have been investing in very different kind of VCs over time. We have the kind of generalist ones that many people know, which are looking at SaaS companies, e-commerce companies, things like that, which have been delivering good returns and strong returns. We continue supporting them, but we see an evolution over the recent years. I would say for the last 2-3 years, we have been seeing the emergence of deep tech, or the return of deep tech. Over 10-15 years ago, semiconductors, hardware was still supported by investors, but it was very cash intensive, it was very long term. Then private investors sometimes could not afford staying in a fund for 10-15 years. Now, the vision is a bit different. The objective is aligned with the market standards of the lifetime of a VC fund, which is usually 10 to 12 years. And we see that it works with deep tech as well. So now, when I say deep tech, what am I talking about? Deep tech for us is everything which is very detailed and strong from a technical standpoint, and where Europe has a role to play to remain a leading player. I'm talking about space. You may have heard yesterday there was a European Space Conference. We announced the last investments that we've made with a specific pilot provided by the European Commission to support the market, and there has been also an announcement for an upcoming 1 billion euros fund to support the space companies. It will be partly through funds, partly through debt products, but this is under discussion with the Commission. This is really important to understand that 1 billion euro has been mobilized by the European Commission to support the market. I'm also referring to artificial intelligence, blockchain, quantum technologies, all those sectors which are definitely important to allow Europe remaining at the forefront, as I said, of innovation, and to generate projects, initiatives, companies that would become not only the continental leaders. The objective is not to remain a European player only. This is to become the global leader and the worldwide champion. And we've seen a number of companies which, over the last 5 to 8 years, unfortunately have moved from Europe to other countries, because this is where scientists are receiving better compensations, where they find more easily money for that kind of projects. Now in Europe, we are supporting this move to go back to, I would say, fundamental elements. And quantum research, for instance, is something really important, which is currently also led by a number of corporations, large corporations in Europe, in the US, in Asia. In Europe, still we are lagging a bit behind. Now the purpose of all those strategic plans that we have for Europe is to allow and to permit the European Union to remain as important as it used to be, and not only one of the most important players, ideally the largest one, and not because we are just looking at being the first one, but we are looking at who would be driving innovation and what can be delivered to companies and to governments as well. So all those elements are the ones that we are looking at, and we will be, with the upcoming program from the European Commission later this year, we will have resources to support those projects and those initiatives.
Thank you very much, David, for this very interesting explanation of, first of all, what you do and what trends you see emerging in the European venture capital area. And I'm very happy to confirm now that Eddy Truell has joined us, and let me introduce him to you, ladies and gentlemen. To many of you, probably he doesn't need much of introduction, but Eddy Truell has been running third-party funds since the age of 16. He has been involved in many different projects. And for instance, while he was the chairman of the London Pension Fund Authority, Eddy masterminded the merger of 260 billion of public sector funds into 7 super pools. He is also the founder, and that is the capacity in which he is here today, and partner of the Pension Super Fund, the first defined benefits pension consolidator in the United Kingdom. Eddy was also the former chair of the UK Strategic Investment Advisory Board. He was in 2014 voted PwC's Entrepreneur of the Year. And last, but certainly not the least important, he was a special economic advisor to the then Mayor of London, Boris Johnson, with whom he still is very close. And he also is a very vocal supporter of Britain's decision to leave the European Union, but that is not the topic of the day. Eddy, welcome to Focus on Private Equity. Thank you for joining us, and we are looking forward to hearing what you have to say on opening up private equity to defined benefit schemes.
Thank you very much indeed, Nicolas, and thank you for that very kind introduction. also one of the early participants in the private debt markets. So you can't take the private equity out of the man, even if I've spent the last 12 or 13 years in the somewhat different world of public markets and pensions. Where are we today in the world? We've got negative interest rates in many, many developed countries. And if you think about them after inflation, extremely negative, severely negative, real interest rates. So as an investor, as a pension fund manager, or even as a private individual with their own defined contribution pension fund, how on earth can you invest to make any kind of return and therefore hopefully secure your pension when you come to retire? A really existential challenge. And it was interesting, I was participating in a conference with Andrew Bailey, the Governor of the Bank of England, and also John Glenn, who's the Chief Minister to the UK Treasury. And both of them were of the strong view that the only place today where you can realistically expect to make any return is in private markets. Infrastructure, private equity, private debt, real estate, and so on. So there's a really strong push in the UK to open up access to private markets for, in particular, defined contribution pension plans. And that's what I'm going to talk about today. What are the challenges? So the challenges are first and foremost that these tend to be run as private partnerships between the private equity general partner, the manager, and typically large, sophisticated institutional investors. So how do you make that construct acceptable and indeed appropriate for much smaller defined contribution, typically personal pensions? The key for us, we think, is to use the public market mechanisms to good effect. Now, there have been some pretty unfortunate attempts to put private equity into public markets. For example, in the UK, Neil Woodford very much and very publicly blew up a year or so ago. The key for us in our construct, and we've been working with the regulators, with the stock exchange, and with JP Morgan in particular, is to construct something that is first and foremost a closed-end investment trust, investment company, so that it doesn't have to redeem those people that want to exit, particularly when there's a rush for the exit like there was in March, April of this year, and people had to put up gates and blocks and basically undermined the liquidity promise. So as you put these things together, make sure that you don't have any liquidity constraints that you might otherwise suffer. And I'm pleased also that I've managed to persuade Martin Gilbert, the former boss of Aberdeen Standard Life, very experienced, to come in and chair a private markets vehicle on the London Stock Exchange. Nevertheless, investors want to know that they can sell their investment as and when they want, and that's where the public market can really help. Because as long as you've got sufficient size, scale, and liquidity, then you can buy and sell your shares as and when you wish. And you can put further mechanisms in place, for example, to have a regular redemption feature so that if the liquidity isn't in the market, people can at least ask the company to redeem their shares. But it is crucially important that they can't compel the company to redeem their shares. Before I go into the joys of AIFMD and MiFID II and other things that I'm sure there are other people who are far more qualified to talk about than myself, I just want to share a little bit of work from the OECD long-term panel on which I'm a participant. Instinctively, regulators have thought that pensions must be safe. And so the vast majority of pension assets are in bonds or government bonds or things that look like bonds There is perhaps a second tier that might be more public equity based, but there's very little private market, private equity in pension funds. And the regulators have been biased against it. But the OECD did some very good long-term studies over 50-year periods. And it's somewhat counterintuitive. But the 100% bond-based portfolio, every single time, underperformed a more diversified portfolio. And indeed, because bonds can only default, or alternatively only pay you back the 100 that you put in the first place, your risk of actually defaulting on your member outcomes or having suboptimal member outcomes, if one wants to be less dramatic, is really significantly more likely in a bond-based portfolio than in a properly diversified portfolio. And let's actually look at what the big pension plans actually do. So if you look at the Canadian pension plans, if you look at the Dutch pension plans, the Australian pension plans, where they have super pooled, they typically will have 20 to 30% of their assets in illiquid, alternative, private equity, infrastructure, etc. And they have been producing very good returns from it. So the Canadian pension plan, CPPIB, produced a 12.1% return on its alternatives over a 20-year period. Now, I'm not saying you should go all in and put 100% of your money into private equity, but don't just tickle around the edges either. Don't put 2% in and think that's going to make any difference. You really, in my opinion, have to have a decent 20 to 30% allocation to a diversified portfolio of private markets if you are going to have a reasonable chance of outperforming on your pension plan. So when I was chairman of London, we put 45% of our assets into illiquids. In the pension super fund, we're going to put about 24% of our assets into illiquids, into private markets. And that provides the long-term risk-adjusted returns that we're looking for. Also in current markets, I'd also like to say that this is the best way we can find to deliver on our social goals and on our environmental goals. Because actually, if you want to have access into, for example, renewable energy, if you want to have access into climate change initiatives, those are typically better done or more, there's more investment choice there in the private investments and private equity than there is in public markets. And fundamentally, let's not forget our main goal is to pay better pensions to people. And when I was in London, I worked out that the average pension that our members had, we had 300,000 odd people that we were paying pensions to, was £7,800 a year. Now you try living in London on £7,800 a year. And that therefore, if we can add up perhaps a 10% outperformance benefit to those pensioners, that additional £800 will make an enormous difference to their lives. And we think that that social goal is one where actually there's a real imperative today to give people access to private equity and other private market investments.
Thank you. Thank you very much, Eddie, for sharing your insights with our participants. Obviously, pensions are the topic that we need to look at and that politicians should take seriously. So thank you very much for your recommendations on how to include private equity into the allocation of the pension funds. We will now switch to our all-female panel. I'm very happy that we have here three very distinguished female representatives of the private equity industry, and I will hand over to Katia Panichi, partner at Luxembourg's Elvinger Prussen law firm, who will lead her fellow panelists through the topic of trends in private equity. Katia, over to you.
Thank you, Nicolas. Good morning, everyone. First of all, a happy, healthy, and successful 2021. I would like to introduce briefly my fellow panelists. We have a connection problem with one of them, but I'm sure we will solve that soon. So let me introduce you first to Hedda Pahlson Moller. Hedda is a private investor. She is also an independent board member. She is an adjunct professor, and she is an impact investment advocate through her company TIIME with two I's. Hedda, I don't know if you want to add anything.
No, that's good. I think I'll have a chance to share some of my thoughts when we start. Thank you so much for the introduction, Katia, and it's a pleasure to be here.
And Vanessa, so hopefully we can hear Vanessa even if we can't see her. So Vanessa is head of the Luxembourg office of Partners Group, which she joined in 2006. She has 14 years experience in private markets, and she has held various roles within Partners Group, going from managing M&A transactions to heading their depository business, and now heading also the Luxembourg office, which also holds the AFM license for Partners Group. Vanessa, can you hear us?
I can hear you. Can you hear me, Katia?
Yes, we can. Hi, Vanessa.
At least you can hear me, but you don't see me, which is not necessarily a bad thing. But jokes aside, thank you for inviting me, and looking forward to our session together.
Thank you. Now today we talk about private equity. We know how 2020 went for private equity, not that bad despite the pandemic. There has certainly been a slowdown on deal making, although in the third quarter we saw some rebound in buyouts. Fundraising has not been that bad compared to previous years. All in all, the private equity industry has had good reactions and resistance. Well, we know that some sectors have been impacted, like retail, hospitality. Others have seen an increased interest, though, like technology, life sciences, and healthcare, and e-commerce. And then, let's not forget, there is $1.7 trillion dry powder out there waiting to be deployed. So today we are going to focus mainly on drivers and trends for value creation in private equity, and we'll touch on three topics: asset class diversification and ESG. There you go, I named it. It's on everyone's agenda, I believe. And then diversity and inclusion. But before I start asking my fellow panelists a few questions, we would like to put two questions to the audience. And the first one is, are sustainability and ESG requirements inhibitors or value creation drivers for private equity? If you don't see the question, you need to scroll down or refresh your page. We'll leave you a few minutes to answer that question. And there will be another one. To what extent do you believe diversity has been adopted by the private equity industry? Now, Turning to our topics today, I would like to start with Vanessa. Vanessa, given the pandemic, which sectors do you believe are private equity firms likely to focus in 2021?
Thanks, Katia. Actually, I like your introduction and also the reference to diversification. Perhaps if I can spend a little bit of time of how we see this from our perspective. So from our view, certainly the pandemic has amplified the transformative trends which we have identified and which actually form an integral part of our investment strategy. What do I actually mean by this? For instance, of course, COVID has brought about more remote working, social distancing, a notion which we are now all too familiar with. And this, of course, has accelerated the digitalization of companies. Clearly, therefore, naturally, digitalization is indeed a key transformative trend. These transformative trends guide our business and actually also enable us to direct our capital, right, to those areas, to those trends, which we believe will shape the future as well. They are actually ingrained concepts in our approach and in our investment strategy, same like relative value, right? So that's a key concept, and same as transformational investing. So transformational investing is about thematic sourcing with a hands-on value creation approach, if I could say that. And I do mention thematic sourcing because you actually were referring to diversification and industry areas, which could be a focus going forward. So how do we actually do this? Our thematic sourcing enables us to focus on themes, areas around these transformative trends, which are driven largely, right, by changes in structural and industry dynamics. So we actually are looking for themes that result in sustainable, above average growth for a period of 5 to 10 years, and we would be looking at 40 to 60 themes at one go at the same time. That might sound like an awful number of themes, but that's precisely purposely done. That allows us to focus on certain, allows us to deprioritize others, right? When we see that the dynamics of the industry and the dynamics of the market change. And it also allows us to phase out when our portfolio has had a key focus on a particular theme. I also mentioned relative value, and I think that's also key, right, for private markets. What we do is actually we also look at overweighting or underweighting certain industry areas, but also the types of transactions, right? Determining whether you actually do a second retail end transaction or a debt transaction is also very much driven by the state of the market as it stands. So in essence, I think in answer to your question, I think the key is always not only keeping abreast of developments, but also having foresight as to how the market can develop so that one can adapt. And that's why I think that private markets are well positioned to effectively be able to handle changing landscapes like we currently are in right now with agility, I would say, and also swiftly, and the fact that there is a longer term approach to private markets that certainly also helps. You would also know that I speak of private markets rather than private equity. From our perspective, private markets goes beyond private equity, and as Ed mentioned before, it also encompasses debt, infrastructure, and real estate.
Thank you very much, Vanessa. Hedda, we will get to the ubiquitous ESG soon, but as you represent private capital on this panel, and you have impact investment as your strategy, would you please demystify impact investment? Tell us what it means, how it relates to asset class diversification, and maybe you could share some trends with the audience.
I'd be happy to. Hi, Katia. I'm realizing there's lots of people on this call that might not be in Luxembourg, where it's snowing here in city center, and I'm sure in the studio over there as well. It's a beautiful day, and I wanted to thank Katia for the question, but also Vanessa, really interesting insight, and the language you use on transformation and sustainability is going to echo what I'm going to speak about as well. So I'm happy to contribute to this discussion from private capital perspective. Now, I know that there's going to be different understandings of what impact investing is out there because there's a lot of people on the call. So I'm going to go through some of the fundamentals, which might help put us on the same page. Impact investing is a for-profit investment activity that creates societal and/or environmental value, so people and planet, alongside of financial returns. It is not philanthropy, in case there's any doubt, but it does have non-financial return requirements. So there's a couple of core elements of impact investing that I'll go through. The first is intentionality. You need to have social and/or environmental impact by design and not by default. 2, it needs to be evidence-based. So the impact, however that's being created, needs to be measured. And criteria 3 will, of course, be what gets measured must be managed. So 3 is managed, and it's not a one-off checkpoint, but rather criteria that need to be monitored and reported on an ongoing basis, and ideally continuously improved. So an investment in financial inclusion or education needs to be about improving the quality and the quantity of the service to the targeted beneficiaries. Notice the word beneficiary instead of just customer or consumer, to make it an attractive target both financially and for the designated impact lens. I recognize for some this sounds a bit niche, so I'm going to try to make it more tangible with examples. But let me begin by pointing out the market size for impact investing has been estimated last year to $750 billion according to the Global Impact Investing Network, GIN. And that's a 40% growth rate and gaining ground fast. So this is nothing to turn your back on. You should be very aware of the drivers in the impact investing space. I'm going to preempt the most standard question I get in impact investing, and it's about trade-offs, the alleged binary between for-profit and for social good being in opposition. Impact investing can be finance first, or impact first, which is concessionary in financial returns. But that is a choice of the investor. So there's plenty of impact investors outperforming the market and others that choose to prioritize the societal impact and allow the capital to be patient and or have lower return expectations. It's important to clarify that this is an investment strategy and not an asset class. So the investor chooses the framework and the metrics, which can range from the United Nations sustainability goals, and I'm sure you're all familiar with all 17 goals we've committed to as a global community, to thematics that can be very personal to the investor's values, such as addressing inequality or poverty or education. But there's also calculated finance-first strategies banking on energy transition, tech for good, the silver economy, plastic pollution, access to water, tackling deforestation, and of course, healthcare, which we're depending on now to bring us through the pandemic. You can invest across asset classes with these filters. So maybe as an example, SDG 5, which is gender equality, that's a thematic that has launched a suite of financial products in the gender smart investing domain, such as ETFs filtering diversity and leadership in publicly listed companies to funds designed to target companies providing solutions or products for women and girls. This week, there was an announcement thinking about the last presentation discussing pension plans. We know that the Japanese pension fund has committed $3 billion to gender equality. So we're going to see this criteria sweep through investment evaluations, given the data on diversity driving performance and returns. For example, I have a colleague from the private impact investing community that manages $1 billion portfolio dedicated to maternal health across asset classes, and another with animal rights as a thematic, which put her in the meatless food industry, which is booming. So her passion for animals drives her investment strategy, and so her returns are double, personally and professionally and financially. My own portfolio uses DEI, diversity, inclusion, and equity as a filter across asset classes. My early stage portfolio is a lot of women-led tech, such as health tech, ESG data analytics, and even a gaming design house that works with the biggest gaming companies to improve the experience and characters to capture the other half of the global market, girls. So by defining an impact strategy and these additional dimensions of evaluation, you open up visibility on new opportunities and markets you may not have considered, and follow trends into value creation and create triple bottom line returns, which is people, planet, and profit. I hope that helps, Katia.
It does. Thank you very much, Hedda. It's very insightful, and I must say I learned a lot with speaking to both of you. Now, ESG. Let's come and talk about ESG. Big topic, I think, for most asset managers here, and maybe we look at the poll question afterwards. If my panelists agree, let's talk first and see what the audience thinks about ESG and sustainability requirements. Hedda, a few questions to you on ESG. So first of all, what is the difference between ESG and impact investment? And then one of the components of ESG is obviously environment. And in terms of climate change, ABP, the largest Dutch pension fund, announced its plan for its investment portfolios to be carbon neutral by 2050. Do you see other investors going down the same route or adopting similar plans? And then in terms of governance, which concerns do you see in that respect that need to be addressed?
Thank you, Katia. Good questions. So yeah, from impact investing to ESG, that's always a transition to differentiate the two. And as soon as the panic around the pandemic and perhaps stock market prices settles, climate change is looming heavily, and we can't quarantine or vaccine our way out of that one. So not just the pension plans, but EU has committed to carbon neutrality by 2050. So it won't take long for the investment community to follow suit. Regarding the difference between ESG and impact investing, apart from the question of trade-off that I addressed earlier, this is the other big one. There's an alphabet soup in responsible investing and finance that's being tackled in the taxonomy of new regulations. And I know that makes most of you wince, but let's differentiate a bit so we can create some clarity on the differences with impact investing. ESG is not, or rather not necessarily or directly, about positive screening to contribute to solutions for societal problems. It's simply smart investing. It's looking at risks and opportunities based on non-financial criteria. So it's a lens. It seems like a bit of a no-brainer, which is very technical speak, I guess, that there needs to be evaluation criteria on the obvious risks related to people and planet. We need to safeguard both. Otherwise, what's the point of profit if we wipe out the others? There seems to be a lot of panic and confusion around the developments and discussions around sustainability. What do you mean we need to be held accountable for human rights abuses in our supply chain or environmental degradation? That sounds complicated to implement. We all know that change is hard, and nobody likes imposed reporting and compliance, but start from a very pragmatic position. Who doesn't want to have a functioning society where human rights and clean air and water are paramount? I get that the new regulations are intimidating and it all seems complex, but we're going to have to buckle down and address our externalities and accountability for the wealth that's being created. It's quite simple at the base. Pragmatically speaking, and from my personal investing experience and my exposure in board positions on multiple funds, you start with what's material for your organization or for your investments. So let the SDGs guide you. Are you dependent on water or wood for your production? Do you have discerning consumers requiring circular business models or waste management? Are you an investor or your investors looking for carbon footprint data? If you have material risks mapped to any of these thematics, or even better, if you see the opportunity of outperforming your competitors for new markets, talent, efficiency gains, you build your strategy and operations to improve your performance on ESG metrics. Check out best practice in industries who are leading. It's not really hard to see who the losers are. They're the ones that don't adapt to increasing demands from investors and consumers and staff and our friends in the regulatory positions. You can screen out the industries and companies to follow ESG performance or even venture towards impact investing philosophy, setting values that can filter. Anyone's worked with ethical investors, such as religiously motivated funds, will be familiar with the processes around screening and will be well prepared for dealing with the Blackstones of the world coming with their non-financial criteria. In some, ESG is a lens to add non-financial dimensions to investment analysis, and it can be ethically motivated in order to negative screen on specific issues or, for example, I'm going to give you some examples: carbon emissions, diversity, transparency. But it can also be an opportunity, and I want to stress that, the attitude of taking this as an opportunity to focus on competitive advantages and adopting to new regulations or markets or demands. And the goal is to improve financial performance. Impact investing, again, goes beyond negative screening and avoids harm by contributing to solutions, which is the ABC model, the Impact Management Project. They don't just measure the mitigation factors, but also the positive societal benefits accrued. Access to healthcare or education, energy transition. Regarding your question on governance, it will need to keep up with the changes to address measuring and managing ESG matters. Going from strategy to operational implementation requires time and effort. Monitoring and management is not straightforward without evolved and universal accounting standards. This is in progress. As a last thought that can bring us back to Vanessa's perspective, the large majority of funds I invest or work with have ESG plans at fund level, but there seems to be some way to go for their portfolio level. Obviously, the pressure is on and there will be alignment, and it's not about if, it's just when. But I'd be very interested to hear how Partners Group is dealing with that, Vanessa, if I can throw the question in your direction.
Absolutely, Hedda, happy to answer. I think as Katia mentioned before, ESG is pretty much the flavor of the month. Though I'd like to say that from our perspective, it has been high on our agenda for a couple of years now. We actually were one of the first signatories of the United Nations Principles for Responsible Investment in 2008. And along the years, right, we continued strengthening our rigorous approach to responsible investment. And I'm proud to say that 2020 was the year where, again, for the 6th time running, we were awarded an A+ rating for responsible investment strategy and governance. Why do we think this is important? I think it is important not necessarily because investors rightly put it on the table. I think it is important because it is a contribution which private markets can make to the responsible investment discussion. Look, in terms of what we do in practice, and Hedda, you also mentioned policies at fund level, but there's room for improvement at portfolio level. What we actually do from our end, we actually screen our investment opportunities against our ESG the D assessment. We actually even have an ESG specific team together with a value creation team. So all our investments are actually screened in this due diligence process. Any findings which are specific to ESG are also flagged to our investment committee. So it's an intrinsic part of the investment process. There's of course also additional engagements and initiatives by our ESG team, which they perform together with portfolio companies. And I can give you a couple of examples, right? So for example, we have USIC, which is actually a leading US company, which is a provider of underground utility locating services. Now, in order to locate services and provide the services, you have hundreds of employees who are actually on the road every single day. We had noticed that there's quite a lot of accidents which do happen. So we implemented a zero tolerance safety program, right? Thereby eliminating a third of all motor vehicle accidents. Equally, we worked on bringing down the environmental impact of using fuel, right? Because there's a lot of fuel which is used, making the trips and standardizing and making trips more efficient and following one neighborhood to the other rather than doing round trips, which are not necessarily helpful. Equally, we have a German portfolio company which actually provides customized cook and freeze products, right? It actually delivers to business canteens and social organizations like hospitals. And we are transitioning from aluminium trays, right, to biodegradable packaging. And already in 2019, we reduced aluminium consumption by 30%. So I think, yes, of course, SDFR is a key topic this year, right? March of this year is implementation phase. But I think it is a topic which many private market firms actually have high on their agenda.
Thank you, Vanessa. Ladies, shall we look at the response of the audience to our questions? Oh, we have Vanessa also now. We see her.
I see you now.
Perfect.
Okay. I need to put on my glasses, otherwise I can't read. Oh, wow.
You look lovely.
That looks good. What? Any comment from Hedda or Vanessa on the results?
Oh, heavens,
I'm
that's
actually
small.
very pleased, right? I think I wouldn't have expected inhibitor, to be honest. Perhaps there could have been more neutral, but I think it is actually the right logic to think of this as a value creation driver.
Definitely. And I have to tell you, the language and the sentiments have changed a lot. ESG and sustainability has been a bit of a taboo topic. You know, it's the S word, and people have been mostly frustrated with it. But I think, you know, the last year and COVID has been a time of reflection. And I see in my own business that the question of how to implement it and how to not just treat it like a threat and a risk mitigator, but also as an opportunity to develop investment strategies and portfolios. I'm pleased to see that more people are on board.
So that's good news, actually, for the industry. So let's move to our last topic, which is diversity and inclusion. You may have read or heard that the Blackstone Group in October 2020 committed to a target of 1/3 diverse representation on its portfolio companies' boards, which is, I think, interesting and good news. Hedda, do you see other firms moving towards the same direction? And do you believe there are other ways private equity could contribute to diversity and inclusion?
Definitely. See a lot of private equity firms recognizing the value creation around diversity, thanks to a lot of reports. And I'm going to try to drop a couple of notes after I speak on some of the references and documentation that might help people that want to continue looking at it. But the business case on diversity is clear, and there's hundreds of reports of productivity and performance from diverse teams. Ernst & Young and IFC have published recent reports on diversity specifically in private equity, pointing out that there's only about 10% of women in senior positions, but listing data-driven arguments why and how it correlates to improved performance and results. Notably, it's been particularly helpful in managing more complex buyouts, but the business case and data is out there en masse. So what's more complicated is the how, and there are different strategies being tested around the world. We know Germany mandated 30% women on boards as the gender gap just wasn't closing on its own. Level 20 in the UK is driving a strong set of initiatives for private equity. And then most of you probably know, and might or didn't notice in December, one or the other, that NASDAQ has requested SEC approval for new listings with board diversity requirements, requesting at least 2 diverse board members, one who self-identifies as female, note self-identifies, and one as an underrepresented minority or LGBTQ+, or an explanation of why this hasn't been achieved. But keep in mind, gender is only one issue in the topic of diversity, but if we struggle with addressing the gender issue, which accounts for half of society, it's going to be hard to address minorities. So there's a strong push towards racial equity that deserves a webinar topic in itself and a long overdue discussion. And I guess as a concluding statement on this, I'd want to point out that leadership needs to reflect the world as it looks. Private equity needs to reflect the world as it looks in all of its facets. and diversity.
Thank you, Hedda. Vanessa, your point of view on this. I know you have a strong position.
Yeah, well, look, definitely, I'll share my thoughts. Right, we are definitely committed to diversity and inclusion, and why is that? Because I think we do recognize that if you are sourcing an investment, or if you want to assess an investment in various industries and various geographies, right, you can only come up with a very good result and a very good conclusion if you look at it from different angles, different perspectives, right? And that's the strong point of diversity. Same applies for our clients. We have over 900 investors with different perspectives. So having a partners group which is actually made up also of the different perspectives, which can understand the different facets of a matter, and which enable us to source the best deals and to create the best solutions for our clients. Certainly diversity will help in that respect. We're of course committed to promoting inclusion as well. In our charter of values, right, we actually say that our people are our key assets and that our people drive our business. And therefore, I think there's a direct correlation between diversity, different perspectives, better conclusions, and that makes for stronger cases, I think Hedda was alluding to. We've, of course, like many other private markets players, taken initiatives, right? Two key initiatives, for instance, where that we wanted to have 20 ambassadors in 20 top universities to engage in a dialogue to attract the next generation of female talent. And we have a target for 2025 whereby we'd like to have 25 managing directors and partners being female. But also, as Hedda said, right, this is not just about gender. There are quite a number of initiatives which Partners Group supports. That's level 20, which Hedda mentioned, is one of them. High Water Women is actually another one. But there's also the aspect of inclusion, the aspect of disadvantaged students or students coming from underprivileged backgrounds. And that's why across the globe, we also support initiatives like the Windsor Foundation, for instance, or Pathways to Higher Education in the Philippines. So I think not only this is topical and a nice to have, but I think it is crucial in actually driving business forward in a better way.
I can't agree more with the two of you. I would suggest we still have a little bit of time, so maybe we can look at the answers of the audience to our second poll question. Okay, so there's work to do there. So no change. Yeah, so 60, sorry, I can't see that far. 67% of the audience believes that the extent to which diversity has been adopted is low. So Hedda, Vanessa, maybe a few last words concluding on that, which means there's still work to do.
Yes, I don't think by all means anybody says or affirms that we're there, right? I think definitely it is a work in progress, but I think it's already good that we do recognize this, that there are specific action being taken, and on our side, for instance, we're committed on this front.
And I think I'll just add the earlier reflection I made. Change takes time. Change is difficult. We have a certain way of doing things. We have unconscious biases. We have standards and ways that we're used to seeing things done, and people we're used to seeing in positions. And it's going to take some time. And I know that there's a lot of challenges to the conversation, but the data is clear on diversity, providing this outperformance and results. So it's nothing to be neglected. Again, data-driven. But how an organization and a culture adopts these changes is different. And I'm very happy Vanessa shared with us what her organization is doing. There is best practice out there. I do recognize that making these adaptations, like with ESG requirements, it's going to take some time, but the results are going to be better for everyone.
Thank you very much, Vanessa. Thank you very much, Hedda. I think we are done for today. So thank you to Nicolas for giving us the opportunity to speak today. And thank you to the audience. Have a nice day and bye.
Well, thank you very much, ladies, for this fascinating discussion on some of the long-term trends that certainly shape the industry, but as we have just seen, also maybe not fast enough. We will now switch to the last panel, where I will be welcoming two of Luxembourg's fund industry representatives, Camille, Thommes, the CEO of the Association of Luxembourg Investment Funds, and Stéphane Besch, the CEO of the Luxembourg Private Equity and Venture Capital Association. We'll be back in a second. So here we are, this time with an all-male panel, but that is because we have invited the two bodies that represent Luxembourg's investment fund and more specifically also the private equity sector. Camille and Stéphane, warm welcome to both of you.
Good morning. Good morning.
Maybe for those of our viewers who do not know your associations, because we have an audience that hails from many different countries, very briefly, what is ALFI and what do you do in the private equity area?
Yes, good morning everyone. Thank you, Nicolas. So our association has been created back in 1988. We do represent a large chunk of the investment fund industry in Luxembourg. Our members are asset management firms active either in liquid or illiquid assets, but also then the whole range of service providers that are part of the Luxembourg ecosystem.
And the LPEA, the Luxembourg Private Equity and Venture Capital Association, obviously has a more focused activity.
Yes, exactly, Nicolas. So we were created in 2010 by local practitioners who really saw and had the intuition that the sector would grow over the next years, which actually happened. We are composed of 200 members, 150 are full members. Those are the GPs, LPs, and family offices. We certainly also have the best-in-class service providers, directors, and also entrepreneurs. We are here really to promote, represent, and defend the interests of the industry, and certainly of all our members. And we are also part of the Invest Europe network.
Given that both of you are covering the interests of the private equity sector, what are you, for instance, doing together for your respective members?
I think there are two elements in that. The first one is that we maintain a constant dialogue. We meet on a regular basis, and that is the management and the president of the respective association to exchange our views, trends and developments, what we are seeing in the market, to share our work, but also to check whether there are things that we can do in common. The second element, I would say, is part of the overall work that's been conducted at the high-level committee of the financial sector, where a dedicated working group, which is led by Alain Kinch, the former managing partner of EY, on alternative funds sector, or the alternative sector private assets, to see how can we further promote the industry, the private assets sector, including obviously PE, and what changes and recommendations we should come up with and work on those to position Luxembourg as an important PE hub. So in a nutshell, we collaborate a lot. I mean, lots of regulatory topics also. So we have both different technical committees and clubs where we can join forces and then certainly work with other public and private stakeholders here in Luxembourg to speak with one strong voice then and represent the Luxembourg Financial Center.
And what is Luxembourg's private equity ecosystem today, and how has it evolved over the last couple of years? Who wants to?
I can
Stéphane.
start if you want. So in the past we had different investment fund structures which were more regulated and allowed you then to also have a diversified portfolio. Thanks to the AFMD in 2013 we were able to enhance further the toolbox in Luxembourg, so to create new business models like the depository services provided by also PSF, so non-banks, to have the third-party AFM model, and certainly also to introduce and refurbish the limited partnerships, which were essential of Luxembourg's success in the field, which allowed also for Anglo-Saxon, American, and also international GPs to find the structures they have used over the last decades and really to create their Luxembourg structure and funds nowadays also here. Yes, I think the market has developed substantially since the inception of AMD. Many asset classes, including obviously PE, have seen a substantial growth, and more recently we've seen strong developments in real estate infrastructure, debt funds. As Stéphane mentioned, I think over the years we managed collectively as an ecosystem to propose new vehicles and improve our legal toolbox, but overall also to look into topics to improve the professionalism, the integrity of the market, come up with industry guidance that would help the players setting up structures in Luxembourg, be they regulated or unregulated.
How has Brexit impacted the private equity industry in Luxembourg?
From our perspective, it has accelerated the whole interest and move to Luxembourg, putting at stake the European passports many were using, and so forcing them to look into new solutions and probably increasing their substance in Luxembourg, having more on the ground than practitioners and their entities. And afterwards that had also a positive effect because we climbed up the value chain, moved then in the past from pure SPVs, holding companies, to then also the investment funds, and now with the AFMs, also new jobs have been created with new profiles, and that is a very strong move in the right direction.
And do you have the impression that Luxembourg has the necessary talent pool for this, as you say, increased value demanded by the industry?
We are all working hand in hand on that specific topic, also with ALFI and others. For example, on our side, on the LPEA side, we have created last year the LPEA Academy, which allows them to get really hands-on experts who share their knowledge and very concrete examples, and for example do it on private equity, on venture capital. We also had, for example, Hedda of the previous panel who participated last year, so ESG is certainly also a very important topic for us as an association. We also had the legal part, because the toolbox is very important, and also here you need to, as mentioned by Camille, also to constantly refurbish, to look into what could we even then create in the future in order to make it even more sexy, if I can say so, or attractive. So those are elements that are very important, and you always hear about the risk manager profiles, which we absolutely need. Some programs already exist, for example with University of Luxembourg. They have a dedicated chair around that. That's an excellent step in the right direction. So we have to look really which profiles do we need and how can we attract them here to Luxembourg, because the country has lots of strengths and certainly a huge quality of life. I mean, when you look
how Luxembourg for Finance explains that to all our friends from abroad. That's very clear. So we have strengths, people in the private equity sector are not just managing the funds behind the screen, they also meet people, they need also then the central location, and then with the right experts, multilingual, etc. So all these elements together make out of Luxembourg really the place to be.
Camille.
Yeah, I would echo that. I think it's been recognized as one recommendation also of that working group I mentioned earlier to improve facets of the ecosystem. Also, the servicing community has developed strongly in that regard to cater for the needs of the PE community, and there are programs, training offerings, work with the university, as Stéphane mentioned, to provide maybe higher level education certificate. So we are moving in the right direction, but we can obviously not rest on our current successes, that's for sure.
Not resting on our current successes, what are the main issues at the top of your agendas? Is it regulation? Is it industry trends, as were discussed previously? What is really keeping you busy this year?
I would say for us as an association, I think there are 4 major themes that we put priorities on for this year, as already last year. The first one is the AFMD consultation, which is responses are due by the end of January, and there are elements in that consultation which obviously have an impact for the PE community. I'm thinking about scope, I'm thinking about authorization, investing in companies, the delegation framework. I think that's an...
Can you give us a sneak preview of...
No, I think what we've advocated for quite a long time, and we do obviously extensive advocacy work, not only in Luxembourg but predominantly in Brussels with policymakers. We've been advocating, for a technical review. I think AFMD has proved to be successful. We should keep it as a managerial regulation, but we should try to improve and maybe fix issues where needed, but we should not go into the direction of a complete overhaul of the directive. So that's AFMD. The second, sustainability. It's been the theme of last year, but also it will be the theme for the next year, and obviously the PE and beyond. And the PE world will not be immune to that change. I'm thinking about SFDR disclosures. Where obviously together or individually we provide technical guidance to the membership, respectively to the community at large. So sustainability is a huge topic. The third, I would say, is about taxation and digitalization, also important aspects for the PE community, where we have to constantly evaluate the changes that are coming, like ATA 2 and taxes, and how does the industry have to respond and implement that. These are, I would say, for me, the major components and the working program for our association. Yes.
And on our side, we completely concur. We work also hand in hand on such topics, very important to the entire sector. And I would just add, for example, data and statistics, very important, because that also allows the message to be clearer, to explain what's behind, include, for example, ESG criteria in the future, makes sense. I would say that was mentioned in the previous panel too, inclusion, diversity. For example, on that, with that angle, we had created that Private Equity for Women group, which is there to help them. Why should they be part of the industry? What are the advantages, the career opportunities, why they should dare? I mean, and then with coaching, mentoring programs, for example. And then I would say, as usual, or mentioned before, the competitiveness of the toolbox. Again, the competition is never sleeping. So let's move on, let's check, are there interesting features to integrate now? Now is a good time, so let's look into the future.
Even if the Christmas period is over, but let me ask you, if you had one wish to improve your area of activity, what would you wish for in the private equity sphere? Would it be another innovation on the toolbox? Would it be on the tax side? Would it be on other issues?
I wouldn't say there's not one answer to that question. I know you said I just have one wish, but I would like to have bits.
You would wish that you could break it down into several
yes,
wishes.
and then,
multiply it.
Yes, to multiply it to make it a big wish, but I think it's a mix of many things. It's taxation, it's the cost and the ease of doing business, it's promotion, it's communication, it's data, as Stéphane mentioned, it's the regulatory environment, including the legal toolbox, talent. So there are many facets to one wish. I'm sorry,
Good.
Difficult to respond to that question.
Gentlemen, thank you very much for joining us today and explaining to our audience what your associations are doing and what the Luxembourg private equity ecosystem is. We certainly will continue to work with you in making it even better. And this brings me to the end of today's episode on private equity. I would certainly not want to end before I also thank our sponsors, Allen & Overy, Cardiff and Linklaters for their generous support. And I invite you to join us on January 26th for our next episode, which will be focused on the Nordics. Thank you very much for joining us today, and obviously, most importantly, stay healthy. Thank you.